Ladies and gentlemen, welcome to The Scoop. I'm your host, Frank Chaparro, Director of Special Projects at The Block. And you can hear on the other side of the mic joining us for the first time in the program, Mike Cagney, co-founder of Figure and Figure Markets, which recently spun out and raised quite a bit of change from the likes of Jump and others to build what we've seen in headlines described as the exchange for everything. Mike, I really appreciate you coming on the program, and it's a really interesting time, especially for us, because we've been digging into everything RWAs here at The Block and the intersection of financial markets and hearing a lot of pitches from folks who want to effectively bring, whether it's debt markets or equities on chain, to sort of yield some efficiencies. But let's get into sort of the backstory here of your firm, right? You know, when we think about Figure, this was a company that wanted to reshape the mortgage, well, specifically the HELOC market through blockchain technology that sort of then gave birth to your own underpinning blockchain infrastructure. And I remember when we spoke, just to give a bit of the history to folks listening, during COVID, right, as it was kicking off, this sort of desire underpinning your work at Figure to really go beyond HELOCs and, you know, to use some lofty language, reinvent, restructure capital markets as they are, specifically the securitization component. And I think that's where we are now with Figure Markets, which I guess you now are devoting the majority, if not all of your time, to this new spin out. So with that history, and I welcome you to provide supplemental information if I missed anything in this, half-decade story here. Why now?
So look, we started originating loans on chain back in 2018, and we're the first to originate consumer loans on blockchain. We did the first warehouse that year. We did the first securitization of blockchain assets in March of 2020. Last year, we did the first AAA rated securitizations of blockchain assets, including one of the deals that we did late last year. The bonds themselves did not go over to DTC, so they stayed on blockchain. And Figure Technology Solutions, one half of our prior business, has been able to capture meaningful economic benefit using blockchain, and most notably around the audit and QC side of things. So the immutability aspect of blockchain, having data certainty and so forth. And we expect that business is going to continue to build in the direction it's going in. Today they put on about $500 million a month of RWA on chain. And I think Provenance, the blockchain they use, TVL in there is, I think, north of $12 billion at this point. I haven't checked the stats lately. And so we've kind of taken the opposite path, Frank, in that, we started with RWA and now we're migrating into crypto and other securities and thinking about it that way, in the sense that what we ultimately believe is that anything that can be represented as a native digital asset will trade on chain and trade on a decentralized exchange. And that's a super powerful construct. So we think about, things like equity trading, for example, and when people talk about blockchain disruption, they're like, oh, you're going to get rid of DTC, the registry. You're like, yeah, you're going to get rid of DTC. You're like, well, are you going to get rid of the NASDAQ or the NYSE? Well, you're probably not. You're probably making a different kind of exchange. But where it gets real interesting is you don't need an introducing broker. So I don't need Schwab or TD or Robinhood. And I just attach my wallet to the exchange and trade. And because I get immediate security perfection, I don't need a traditional prime brokerage ecosystem either. And so, we're embracing this whole concept we call democratized prime, where we're going to let anyone who has cash put it up to lend, and anyone who wants to borrow, put up securities or crypto to borrow against that, and effectively level the playing field where we don't sit in between sources and uses of capital. It's just on the exchange. And the key thing about the exchange, if we think about, the right way to build something today, we started with decentralized custody. I mean, what FTX has shown us, what, the bankruptcies have shown us, centralized custody is very orthogonal to the premise of blockchain and introduces a huge amount of risk. We focus on liquidity, and obviously having partners like Jump Crypto help us a lot on the liquidity side of what we're doing. But we're also very focused on getting lots of dollars onto the exchange to borrow, getting lots of asset management product on the exchange. So, we recently pulled together a fund to bid on the Solana auction. We have another one coming together right now to bid on Wednesday's auction. And if those funds are successful bidding, then those would trade on the exchange. But the key is they'd then be allowed to cross collateralize to those funds. So being able to put your fund interest up as collateral against a Bitcoin perpetual, for example. And that cross collateralization is one of the key things that's necessary, because I've seen a lot of these vertical RWA attempts. So, we've seen multiple entities try to take an office building in Atlanta and sell you, tokenized ownership interest to it.
That was like the 2018 wave of tokenized securities.
That's right.
We're going to take that dorm in South Carolina and give you exposure.
And in fact, it was a dorm. I don't know if it was in South
Carolina.
But
it's really just I think it was a dorm. I think it was in the American South. But these were really just wrappers, right? Like private placements in a tokenized
That's
wrapper.
Right. And you got the same thing out of a digital LLC, right? There really wasn't a value in it being on blockchain because it wasn't trading. You didn't need that real-time bilateral, self-settle, self-clear. The asset wasn't native digitally, so you still had to trust that the dorm was actually there and you had an ownership interest to it. And you couldn't do anything with the asset. You couldn't collateralize a Bitcoin position with it. And so that's really what we're pushing on, is this idea of a marketplace of everything, and very much focused on native digital assets, but still allowing for the tokenization of physical assets with a trusted oracle, but having this cross collateralization capability where when you're looking at your ability to borrow or lend, you're looking at the holistic asset picture, not just your Bitcoin position.
So it's sort of marrying the sort of decentralized nature, the transparency of and the crypto infrastructure of something like a Uniswap, with the ability to leverage and tap into a vast array of different assets that you see in traditional finance, whether it be I guess you're starting with sort of I don't know exactly what you're starting with, but it'll probably open up to equities, maybe government bonds, and the like. So walk us through then the sort of roadmap to get to that ultimate vision where folks are going to be able to tap into a platform where they're going to have sort of the same type of prime capabilities that they'll have on Wall Street, but with a sort of more crypto interface.
Yeah, so it really starts, as I said, with the MPC wallet. And the MPC wallet allows us to do something that's been very difficult historically, which is decentralized custody, but creating security perfected interest in those assets and allowing for cross collateralization. So the challenge you historically had is to trade on the centralized exchange, you have to move your assets to the centralized exchange, and it can look at those assets collectively. As you know, Bitcoin and Ethereum are two different incompatible networks, and so they don't coexist. And so the exchange would just take possession of both and tell you have both. So MPC allows us to have Bitcoin on Bitcoin, Ethereum on Ethereum, hash on provenance, and create security perfected interest there, that those security perfected interests can be what trades on the exchange. And it creates a mechanism that allows for cross collateralization of those assets. And so what we're focused on is today we have a very large institutional lending book, and then the asset-backed securities marketplace with what we've done on the HELOC side. And those are the traditional players in that space, like the Apollos and the KKRs that buy those loans and buy those securitizations. And we made a couple of attempts to try to drive broader retail adoption into it. So we created a platform called Figure Equity Solutions, where we onboarded 600 companies, cap tables onto Provenance, with the expectation that they'd run secondary markets and people would want to come in and trade stock. And the reality was nobody really wanted to trade the stock. Nobody wanted to list it. Nobody wanted to trade it. There was no market making for it. We tried the same thing with funds. We created a platform called Digital Fund Services. And we got Apollo and some other big names on that platform, but nobody wanted to trade the funds. And that's where we took the step back and said, hey, look, let's look at market structure. And that's where the MPC light bulb went off of, the market hasn't learned its lesson from FTX. The centralized exchange risk is still there. And so MPC solves that. And as we were leaning in and thinking about all the things we could do with MPC, like around cross collateralization, we were fortunate to get the interest of partners like Jump Crypto, who lent in and said, "Hey, we'd like to be a part of this. We'd like to put some capital in and provide some liquidity onto this platform." And it really introduced the question of, well, what else is going to trade there, right? Because I have this barbell now that in the U.S. on the onshore platform, I have Bitcoin, I have Ethereum, I have Hash, and I've got institutional loans and asset-backed securities, and it's kind of a broad extreme between those two things. And the obvious question is, how do you get equity on? How do you get yield investments on? How do you do these types of things? And so, the reason that we had been very engaged in both the Celsius and the FTX bankruptcies was we saw that as a path to get equity listed on blockchain. So when a company is in Chapter 11, there's a process called 1145 that allows you to issue public equity directly through the court. So there's no S1. And we have an alternative trading system that allows us to support those securities for secondary liquidity. So we can actually create a market on a blockchain native equity that real-time bilaterally self-settles, self-clears. And so, we made that run at Celsius to try to get that. It didn't work. We made the run at FTX to try to get that. It didn't work. The debtor has taken a different direction, I think, on that platform. And so one of the things we've been thinking about is, well, how do we solve the equity problem? And one way we can solve it that we're contemplating is, effectively doing a Reg S issuance, meaning that there's no limitation for offshore investors, and doing something analogous to an airdrop of equity. And, in doing that, we would broach 2,000 investors. We'd be a public reporting company at that point, but we would have secondary liquidity on the ATS. And so, it's not the same as doing an IPO and going public that way, but we think it's a way to, effectively create public equity on the blockchain. And I think when people see the amount of liquidity that goes into that equity, it's going to facilitate other companies to start thinking about, well, should I list here? If you're a miner, for example, on the NASDAQ, I use BitDeer as an example, you have $5 or $10 million of trading a day. That's it.
It raises a really interesting question, which I've been pondering myself. Why haven't we seen companies like a BitDeer or even Coinbase, right, which is, issued a lot of debt, eat their own lunch and sort of, everybody when Coinbase was gearing up to go public was wondering if there'd be some sort of side pocket token element or even just a token, security token offering itself. It didn't end up going that route, obviously, but the question is why? And I think, it really speaks to the extent to which, how early we are in terms of crypto penetrating market structure, because even the crypto companies aren't doing this.
Yeah, it's one of the great ironies that blockchain is a democratized, decentralized platform, yet all the tokens trade on centralized exchanges. And why should that happen? And one of the hindrances, one of the headwinds that's come into this has been FTX, in that FTX was running single stock perpetuals offshore. It was growing pretty rapidly. They were getting a lot of focus and attention in on it. The market mistakenly felt that a crypto investor wasn't, a Tesla or an NVIDIA investor, but they were, and they did want to cross over and have that capability. And when FTX blew up, it really, put a damper or a headwind into someone leaning in to do that subsequent. I think there's a huge opportunity there. I think that being able to integrate equity and crypto, and in a cohesive way, not in the way that a Robinhood would do it, for example, where you have two very distinctive platforms, you have to move your money from one to the other, but just out of a common front end, being able to buy equity and buy crypto and cross-collateralize the two. That's where the market has huge amounts of value. It's totally greenfield. There's an enormous amount of value to tap into that. And that's one of the key things we're focused on.
I mean, when you think about what FTX was offering, these are really just, in a sense, like a tokenized ADF or something. Like it's not actually, getting sort of a sort of like, issuance on chain or something sort of like that.
You're right. You're right. And that's where having the alternative trading system that we have that supports blockchain native securities in the same MPC wallet that my Bitcoin or my ETH is in, right? And supporting that cross collateralization, that's the missing ingredient. And, that's something that we've been fortunate to have gotten, several years back. We've used it extensively for our own equity offerings. For example, the first marketplace we ran was Figure Equity. We ran a 24/7 limit order book for our stock.
Mm.
And so the ability to do that for public equity is going to be a major milestone for the market. And that's one of the things I'm very, very focused on this year, making that happen.
It's interesting. A lot of, as you're sort of building, I've noticed and I've seen a number of different firms try to, in the wake of FTX, rebuild crypto market structure, whether it be centralized or a blend of both, right? Whether it's BitGo Go Network, FalconX recently just announced sort of basically, you can think of it as like a segregated proprietary wallet where they give sort of like a tri-party collateral in a sense, and then an exchange. I think Deribit's the partner, gives them credit held in that wallet. So everyone's trying to achieve this cross-margin finance problem, or create these, I guess you can call them ecosystems that they sort of maintain, where through one interface, folks can sort of trade against multiple venues or trade with multiple venues without having to sort of move their coins out of a sort of secured storage in a sense. And I'm sure there's others. It's a clear loop model. If Copper and something like that, everyone's trying to stake their flag, or not stake their flag per se, but sort of carve out their own niche in this sort of arena.
Yeah, the challenge you have though is the examples that you cited. They're closed loop networks, and that's the issue. Is you have to be on the BitGo Go network, for example. You know, it's not cross compatible into whatever Anchorage might have or whatever Komainu might be doing, and so that's why I think the MPC is so powerful, because your Bitcoin stays on the Bitcoin network, your Ethereum stays on the Ethereum network. You put it into an MPC address. I think at some point you're going to get qualified custodians to be policy signers on the MPC, and hopefully that would convey a qualified custodian status to the MPC structure. But that's the power that you have there, is you're not limited to any one provider.
So to start, it seems we kind of went in through thinking about how you guys might reshape traditional market structure, but really, in the present moment, you're competing with some of these centralized players for flow, for active traders, for institutional market participants keen to trade, let's call it the big names like ETH and Bitcoin, and sort of have access to those more institutional grade tools, whether it's prime services or access to credit. Let's sort of like maybe put that aside from just a second, because I want to tap your insight to get a sense of what you think about how sort of developments like what we're seeing with BlackRock and Securitize, and there's another of other smaller players like Robert Leshner's firm. So you have a number of these players, right? And my perspective is, in the short term, right, similar to how you're in the short term going after this Bitcoin ETH flow, the BlackRocks of the world who are getting in this, they see the USDC Tether flow. And it's not really a story of like, let's tokenize the world and all hold hands. It's really, there's $100 billion of stablecoins out there that we want to cut from. I want to get your take on that, but I also want to get your sense of how then do we go from where we are now, kind of operating within these small sort of crypto markets, whether it be in your case, like, the large caps or decentralized finance trading, or whether in BlackRock's case, maybe trying to get a big chunk of what's going on in stablecoins. How do we go from that to this broader world where markets are just on chain, whether it's Coinbase issuing debt, or whether it's MicroStrategy stock trading on a DEX, or whether it's securitization being bundled through tokens, and then all of those things being interoperable in one capital markets?
Yeah,
it's a lot.
But it's a great question, and I think the challenge that we've always had in any blockchain transaction is representing fiat. And we've had USDT and USDC as ways to represent fiat, and they've had two significant headwinds. One is inability to pay interest, and one is, they're crypto, and so no U.S. bank can touch them. And that's extremely problematic because no one's going to build a payment rail off of USDC when the bank acceptance can't actually touch the coin. And so the BlackRock solution was a really interesting first step in the sense that they created a money fund and through a partnership with Circle provided real-time liquidity into that money fund. And I'd push back a little bit in the sense that 100 billion of stablecoins it sounds like an enormous market. That's actually not a big enough market for BlackRock to really lean in. I think BlackRock's view is there's trillions of dollars of opportunity here, right? And that's why they're focused and they're trying to lean in. They're not trying to take Circle and Tether's lunch. They're trying to create a much bigger pie of which they own. And so the ability to provide real-time liquidity through USDC for that product was a really important step forward. More recently, Franklin on their Benji fund or Benji token, they now have peer-to-peer transferability of existing customers. So if I already own some of that fund and you own some of that fund, we can now move it to one another. That's a really important milestone forward too. And it's getting to what you ultimately want, which is a public fixed income security that's freely transferable peer-to-peer. And if you look at the S1 that we filed back in October, that was just updated a couple of weeks back, that's what we've been petitioning the SEC for. And we think we're at the end of the process and very close to getting approval for something that is public fixed income security, pays a continuous yield, freely transferable peer-to-peer. And because it's a public security, there's no limitation on bank ownership, right? So it's not crypto, it's an actual security. And so this, I think, gets you to the last mile, which is opening up payment rails, opening up cross-border remit. Like, now you have fungible currency that, can move across any KYC wallet. That really opens the door, not just for crypto trading, but for a bunch of TradFi use cases that we've been kind of banging our head against the wall for the last 3 or 4 years trying to crack because we haven't had the right vehicle to do it.
What type of company, once that infrastructure is in place and once you get your blessing, is going to be keen to sort of maybe, issue a bond through that sort of infrastructure? Does the company need to, is the first step maybe, I'm using we very liberally, I have nothing to do with any of this, but are we maybe putting the proverbial cart before the horse, in as much as I can't imagine a company would do that before even accepting crypto as payment, yet there's very few that do.
That's one of the things I think you're going to see happen. I think, if we were to get yields approved, which hopefully we do get that approved, and again, this is a public S1, so it's out there in the public domain. I would expect that you'd see some of the larger banks like a JP Morgan go to their customers and say, look, we will set you up to take payment in yields. And in doing so, we're not going to pay the Visa, MasterCard interchange economic. And they might work with the issuing processors for point of sale on the front end, but they would be merchant acquirer on the back end. And you'd see, now a blockchain native currency transaction, security transaction. I think that the same thing would happen with cross-border remit. Today, I always laugh that when I go to the grocery store and I see a Coinstar machine, one of the biggest businesses that machine does is it allows people to buy Bitcoin and move it to people, right, at the kiosk. And it just shows you how much friction there is in cross-border remit. So the ability to buy, effectively a money market type security and then move it real time to a recipient, cross-border, that's massively transformational for money transmission and the remit business. And so I think you're going to see those two areas lean in aggressively around this technology because they have the biggest amount to gain in terms of economics and rent to earn as being first mover off of that. And then I think as you get ubiquity, I believe you'll see firms like Jump and other market makers start making two-way markets in yields versus Bitcoin, yields versus dollars, yields versus euros, right? And providing the foundational liquidity on the back end, and that will beget a broader ecosystem. And again, this is what I think is a catalyst we've been waiting for on RWA, and that the biggest limitation we've had is representing fiat. And, and it wasn't as big of a deal a few years ago when the interest rates were zero, because you're like, okay, my USDC pays me nothing, it doesn't really matter because I'm going to earn nothing anyway. But now, 5.5 is a real amount to give up as opportunity cost.
Yeah. And folks are, chomping at the bit to find another option. It's really led to this boom, whether it's Mountain Protocol or Athena. And I think a lot of people are leaning into this space because there's a lot of interesting questions about what these things are. How are they similar? How are they different? Are they money market funds? Are they hedge funds in some cases? Is Circle a money market fund? I mean, we're still kind of working through the taxonomy of a lot of this, which is quite interesting. I don't know if you have thoughts on that, right? Because it's kind of interesting how a lot of these things are operating in a similar type of environment, but and are many things like Circle, like USDC, right? And something like BUIDL. They both offer exposure to government debt, but are fundamentally two different things. One's maybe more of an investment product, the other one's a payments tool, but they have kind of the same underpinning.
Yeah, I mean, the challenge you have with both is when you buy that token, it's a general obligation back to the issuer, right? There isn't anything that's specifically sequestered that this is your claim, and that introduces a lot of anxiety. Now, I think people are comfortable with Circle because of being a U.S. company, having the relationship with BlackRock. The expectation is, hey, the dollars are there. But remember when Silicon Valley Bank went, and it turned out they had a bunch of fiat at SVB, people got pretty concerned. Right? Yeah. They broke the buck for a brief period of time, and then they came back up. And so, it's you have to remember that when you're buying stablecoin in that construct, you're really just giving a loan to the issuer. And, in this case, you're giving the loan for zero because you don't earn anything on it.
Fair enough. When you think about, and maybe we can even, unpack for folks the efficiencies that even something like what Figure does in HELOCs, generalize sort of the power of moving capital markets on chain. I was speaking with someone who runs a credit fund in crypto who said, a lot of what we do, and it's not crypto specific, but they're sort of doing the securitization on chain. You're removing 70% of the cost by doing a lot of this in smart contracts. Can you walk us through, maybe specifically with HELOCs, and then generally, what is actually being done? What can be done through smart contracts that offers this level of efficiency?
Sure. So I think it depends on the underlying asset class, but let's use HELOCs as an example. When we securitize HELOCs, every deal since 2008 required a third party to come in and review every loan. So you pay a company called Citus to come in and do this, Citus AMC to do this. It's $500 a loan. And that's just the cost of doing business, because for the securitization trust, for the AAA rating, the rating agencies want every loan reviewed and signed off on and buttoned up. And the challenge in the mortgage process, as we saw from 2008, is you didn't control the quality at origination and you didn't control the data subsequent. And so what we did in our situation is we said, look, we're going to do a digital process to originate a native digital asset onto chain and leverage the immutability of that blockchain so that for certain what you're seeing is true. And I always say there's two things blockchain does really well. It allows you to displace trust with truth, and it allows you to transact bilaterally without counterparty risk. And if you can't do one or both of those things, there isn't a huge amount of value in using blockchain. And so in our situation, we've been able to get the rating agencies comfortable with auditing 30% of the loans at a cost of around $100 a loan. Right. So that cut 70% of the loans out, and of the remaining loans, $400 a loan of cost out because of the technology. And it's one example of many steps in the process where the immutability of the blockchain actually creates, and that trust versus truth creates significant value.
Understood. And so that sort of, it removes this, it's interesting because everything seems to just go back to to FTX in a sense, right? Like it illustrated the extent to which this behemoth in our space and its downfall illustrated the actual value of the underlying assets that this platform was facilitating trading in,
100%.
and it's the ability to see these transactions. To what extent has sort of the meltdown of crypto's credit markets could serve or has served as a tailwind for your firm, right? There's a hunger out there for credit. I mean, even Coinbase, which has begun doing some lending and is building out, I would say, based on my knowledge, some form of a desk. I think it was in their last earnings, but that's still a $500 million book compared to Genesis at peak was maybe 20 billion or something in that range. And I mean, I've written about this a few times. I think it's a major tailwind for crypto because you have in one corner higher interest rates. So the meltdown occurred in a time of ZIRP, and you had the market was flush with credit. And now we're in a situation where we have high interest rates that were supposed to come down, may come down later than we thought, and but nobody really knows. It's kind of just finger in the air, and no credit. So I guess that's just painting the picture. But the question is, how do you lean into that? How do you lean into that macro environment and that credit environment to push your business?
Yeah, so there's a significant opportunity, and one, the lenders that were there 2 or 3 years ago aren't there anymore, so that capital's gone. And then two, the ETFs have caused a bit of a challenge on the exchanges because when you get the inflow into the ETF settles T+1, but they buy the Bitcoin T0. And so they effectively need to float the financing for 24 hours between the point of purchase and the point of receipt of cash. And that's created a real crunch. And so if you go on, Binance today, for example, and you go to look at a VIP 3-month loan rate for USDC, I looked yesterday, it was 120% annualized. And, so there's a definite shortage of dollars on the exchanges. And I think that this introduces some opportunity on a couple of different fronts. I mean, one, obviously, we're a major capital market player, so we have access to capital. And one of the big differentiations with Figure Markets is we intend to bring an enormous amount of dollars onto that platform, so that if you want to borrow on both term and intraday trading, you have the ability to do that. But it also opens up an opportunity where right now we're bridging between TradFi takeout and DeFi lending. And the challenge is the TradFi market doesn't really understand how much better a Bitcoin-backed loan is than a HELOC, for example. And because I have 24/7, 365 perfection of my collateral, if you hit a margin limit, I can liquidate you immediately. I'm going to get paid back in that loan. And the question they always say is, well, what if Bitcoin goes to zero? And I'm like, well, as long as it doesn't go to zero in 2 ticks, we're okay. And we've shown them the historical data on this. But what I'm going to try to do this year is I'm going to try to securitize a pool of Bitcoin and Ethereum backed loans. And I think I can get that done. Hopefully I can get that done at a AAA level. And I think that'll really open up the market because it'll significantly reduce the cost of capital. And
where's that going to trade?
On Provenance, on Figure Markets. So we'll do an asset-backed issuance, and the bonds will trade on the blockchain, and our members will be able to buy that if they want to buy yield. They can buy into that. But I think that level of maturity is going to come over the course of 2024, and we should get to a more normalized capital ecosystem at the end of the year.
How much interest is there in engaging with these sort of, can we call them outposts to Wall Street? This stuff isn't really at the center of what, where these banks are engaging, where these institutions are engaging on a daily basis. How difficult is it for folks like you to get them to sort of cross over?
Well, I think we spoke about this when we first spoke. The reason that we created a lending platform and created a really attractive asset was we use it as a club to force the hedge funds to start buying on chain. because everybody wanted to buy the asset. No one wanted to deal with blockchain. And we said, well, you're not going to get it unless you buy it on blockchain. And then, when the hedge funds came on, we went to the sell side banks and said, you got to warehouse them. And they said, well, we don't want to do it on blockchain. And it was like, well, then you can't do it. And so in the beginning, it was hard. And it required a lot of effort and a lot of persistence. It is getting easier now because the proof points are there, the economics are there, right? And people are seeing, hey, I can save money, I can go faster, I can drive efficiencies, and that's always what we've needed, right? We didn't need airdrops of the fanciest, flashiest new token. We needed sustainable use cases that demonstrated the technology was valid. And I used to have to deal with people walking around all the time saying blockchain is the hammer looking for the nail, right? The solution looking for the problem. And there isn't a problem. And now, I think we have enough track record and enough demonstrated economic success around that to say, no, it actually does solve a whole bunch of problems. And by the way, like when you talk about it to the extent that we spoke about earlier, the level of disruption it's ultimately going to bring in, the disintermediation of introducing brokers in the prime ecosystem, that's trillions of dollars of market cap you're taking out, right? And so the opportunity is massive. And it's just, I think we got distracted. I always say blockchain never loses an opportunity to shoot itself in the foot. Like we got distracted with the ICOs. We got distracted with the NFT boom. We got distracted with the FTX collapse. But along those ways, some really good stuff has been built. Good infrastructure has been built. And I think, this year and next year, you're going to see some real use cases that, will legitimize the purpose of the tech.
Meme coins for this cycle maybe serve as the most recent distraction.
Indeed.
How big of a headwind is the regulatory environment?
It's tough in the U.S., but you can navigate it. It's navigatable. I think there's upcoming there's proposed stablecoin legislation that's being introduced that opens up some promise. I have a lot of sympathy for the regulators because they're in a situation where there isn't clearly defined law. So everyone points to the SEC and blames the SEC. And the issue with the SEC is they have to interpret because there isn't an explicit rule or law that says this is how things work, how it doesn't work. And I think really the finger pointing should be at the Hill. Like we need regulation and rules, and then we need we need rules and we need regulators that enforce those rules. So I'm sympathetic, and I think but there's a perception that outside the U.S. it's a panacea. It's not. Like every country has issues and concerns and problems and doesn't know exactly how they're doing things. And like the UAE, for example, will look to the SEC for guidance and direction. And so nobody's figured this out yet. I think there's a tremendous opportunity for the countries that do because it's going to attract a lot of talent.
Yeah,
and capital.
And you don't necessarily have the robustness that maybe will make certain participants feel comfortable in these offshore jurisdictions that many crypto companies have been flocking to.
That's right.
They might not find customers flock as well. In terms of sort of the underpinning market structure of how this works, right? It's a central limit order book for figure markets. So you're not really dealing with automated market makers. How do you sort of think through like the drawbacks of AMMs and I guess that leads to another question, which is in a future where, maybe we're 5 years out from this conversation, we'll have you back on. Where are the Uniswaps? Where is their role? And other sort of AMM-based models.
So and a lot of people will take strong exception to this, but I firmly believe that the reason that AMMs exist is because you can't get the throughput on a decentralized limit order book on a public exchange, public blockchain, and AMM solved that problem. But in solving that problem, they introduced a bunch of other challenges that they had to overcome. A couple of years ago, it was sandwich attacks, and now there's other issues that are happening now. And so I truly believe limit order books, especially, a limit order book where you're running effectively mini auctions on every bid offer cross, to prevent front running and the things that we have on the equity market today. Huge. That's where the industry will go, but it just needs the throughput ability to do that. And so I think, as we get improved performance on the computational side, I think there's some pretty interesting opportunities in which we can see real scale happen on chain.
Understood. Okay, so thinking, if we think about what we should expect next out of Figure Markets, what did the next 6 to 12 months look like? What should our listeners in the market anticipate?
Yeah, I think a couple things. I think onshore, having a very robust borrow lend market and moving into what we call democratized prime, where we allow people with cash to put it up for offer and people who need cash to bid to that. Those will be some pretty important components. And then I think offshore, some differentiated products. So we're talking about standing up an Ethereum gas perpetual. We're going to lean in and do the single stock relaunch, that used to exist on the FTX side. We'll be doing some FX perpetuals integrated into the crypto markets as well. So, some innovative product, and then, opportunistically and programmatically asset management solutions like, what we're doing for the Sol auctions now, and, what we plan to be doing over the next, call it 2-3 months with real world assets.
Got it. And where can folks learn more?
Figuremarkets.com. We have a Telegram group as well. It's very active. I'm on Twitter. We're on Twitter. So a bunch of different mediums. And the Discord group should go up this week.
Yeah. And you're hiring, I imagine.
Yes. Hiring across the board.
Well, thanks so much for joining the program.
Awesome. I appreciate you having me.
Yeah, no worries. And the Scoop will be back for you again. Have a great day.